Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. What's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. And the boys are back at their desks. They are back from their travels, back from Brooklyn, back from permissionless. We're back at our desks. Feels good to be back in the routine. What's going on, guys?
Not much. Just getting ready to celebrate Independence Day down here. Felix, are you celebrating your...
What was it? Ours was 2 days ago, July 1st. We love to just keep it slightly different from the U.S. There were some fireworks for Canada Day, but not nearly. What do you do? Yeah.
Yeah. Do you drink?
Yeah. Well, first we do land acknowledgements, and then we. No, we have a good time. I don't know. There's drinking, there's barbecuing, there's fireworks, there's parades, there's all that stuff. It's
a lot of Labatt.
A lot of Labatt blues.
When we were at the bar in Brooklyn, Felix got so excited. He was like, "Oh my God, they got Labatt! I love Labatt. It's the most Canadian thing ever."
Yeah, bud. Yeah, I got multiple people come up to me and be like, "I saw you drinking."
Yeah, so good.
You know, one might say that Quinn actually had a couple beers go to his gut based on this photo.
Look at this guy. He went from 170 pounds soaking wet to man boobs and 45 years old. Look at that. No. Looks like he's been taking estrogen for
wait,
months.
Quinn, get some. What are we looking at here? What are we looking at? Here?
So after I came back from back to Florida, I was at this restaurant and I was paying, and this guy came up to me and he's like, so shout out to Ethan. This is Ethan in this picture. He watches the show, so hopefully he's listening. But he's like, "Are you the finance podcast guy?" And we just ended up talking for a while. He said he's a big fan, listens to the show, and then I had to include the comment that he put. Saying,
You're my favorite.
Those other guys clearly fall intellectually flat. He was joking. After he said, "Okay, if you could use that comment on the show," and when we sent it to Tyler in the group, everyone's like, "Oh, that's cool," and then Tyler just immediately roasts. Just
what happened in those couple of days after permissionless? You're looking hefty.
We got to burn that shirt. Whoever makes that shirt, we got to send them. You look like you're 240.
Yeah, but then there's this guy too.
I put that in not to roast myself. I look at the one picture I got out of permissionless. I look like I'm a little bit retarded, and they just gave some dumbass a microphone.
I had to put my half marathon time on the next slide so Tyler can't roast me. So I proved that I don't actually.
I got roasted by that stream for wearing Birkenstock, so I got a big blister on my foot, so I couldn't wear normal shoes. So I was wearing those Birkenstock sandals. I got absolutely decimated by people for it.
Dude, you look so Canadian with those things on. There was one guy that showed up in Tevas, so I couldn't really roast you for the Birkenstock.
I respect it. Anyway, a lot of fun. Great to meet everybody that was there at the meetups and all of that. Really great time. All right, let's get down to the brass tacks here. Get serious for a minute. Draw support day. We're recording here on draw support day, and so just going to run through a few numbers here, set the stage a little bit. Non-farm payrolls came in above expectations, 147,000 versus consensus at 110, and the unemployment rate ticked down pretty significantly. So it was expected to go from 4.2 to 4.3, but it actually came down quite significantly to 4.1%, which is super interesting. We'll get into more of the why of that in a second, but also saw some upward revisions in May up to 144K, which is interesting. And if you just compare this unemployment rate, just to show how much of a downside surprise this just shows what the last Fed meeting from June, the SEP projections were for the unemployment rate. And they had it pretty mechanically heading higher to around just under 4.6% by this time next year-ish. And yeah, pretty big reversion down, which was just super interesting. And the big reason why is if you look into what was driving this, and going to give you props for being all over this, and I know you have some slides that will relate to this as well, but so much of this story is immigration and just the significant whipsaw that we've seen in it, where the main driver, if you look into the unemployment rate, is actually just the change in the labor force, the total labor force. And overall, if you think about last September, we're in the situation where we had huge amounts of immigration. You can see up here, that was leading to a higher unemployment rate, because as these new entrants come into the economy, they get counted as being unemployed until they start to get a new job. So you just have these huge flows. And that was one of the key reasons that we saw such a surge back then that actually triggered the SOM roll and everything. And later on, we quickly found out that this was mostly just a false positive. And now we're in the opposite situation, where, as you can see, land border encounters are just absolutely plummeted. So we're seeing a decrease in the labor force, which is leading to a mechanical decrease in the unemployment rate, which is super interesting. A couple other things as well is, if you just look at the non-farm payrolls overall, look good and rosy, which is great. But if you dig into just comparing government jobs versus private payrolls, so private payrolls actually surprised pretty significantly to the downside, where we saw a pretty significant decrease below expectations, about 74,000, I believe, and a huge surge in government payrolls. So this is an interesting one, because, let's just look at the last time we were up here. It was like April 2024 was the last time we saw government payrolls at this level. So pretty interesting, and definitely want to get your guys' take on comparing that and contrasting it with the whole Doge movement and where that nets out. But yeah, overall, if a couple other things on that, I'll pause here, is if you just compare that. So the ADP print came out, I believe yesterday or the day before. And this is, people always will speculate and hyperbolize on what it means in terms of projecting it into the non-farm print. And what's really interesting is just the huge contrast between the two prints right now. So we're getting negative prints on ADP, and then pretty upside surprises in non-farm payrolls. And if you dig into the reason why, this is a great chart from Neil Dutta from Renaissance, and just looking at how this comes down to education and health services and the change there, where we're seeing some pretty significant downticks in the ADP print, but we're still seeing that positively incrementally head up in the jobs report, which is super interesting. So last one here is just looking again, it's important to really dig into the education and health services side of things, because this has been the huge growth driver of payrolls over the last few years. You can see that it's just been like this huge driver, and it just is continuing to unwind lower. So if we are going to see any sort of meaningful weakness in the labor market, it's quite possible to come from there. But overall, my big takeaways are that it's a jobs report that looks good on the surface, but when you dig into it, there is some causes for concern, but still not really anything meaningful to really wake up and panic the Fed. And I think it's, they're very focused on just what is the unemployment rate at, and where does that sit within their projections, and how does that translate into monetary policy. And, by all accounts, I think it means that July is off the table for cuts. So pausing there, what was your guys' read on that and just the state of the economy right now? Want to earn real yield on your Bitcoin without leaving the ecosystem? Echo Protocol is the first Bitcoin liquid restaking and yield layer built on MoveVM. It powers the BTC Fi economy on Aptos, securing nearly half of all bridged assets on the network and minting over $200 million in ABTC. With Echo, you can easily acquire, hold, and earn on Bitcoin via ABTC, their yield-bearing Bitcoin asset. Echo already makes up around 70% of Bitcoin supply on Aptos, and it's just getting started. Learn more at echoprotocol.xyz. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
My main thing is these releases. I think everyone makes a big deal about. I say this every week, but 0.1% in unemployment rate, like how much of that really matters? It doesn't really matter. Like, look at the market reaction. I have a bigger, macro thing, which I look at seasonal volatility, and in July, as soon as the jobs report number comes out, bam, VIX sells off and the market rallies. And I have a good seasonal chart later I can show you on VIX vol in July, which is just, it absolutely craters because everyone's on vacation. And so unemployment number, I don't know. I mean, it's probably trending lower. I think the economy is probably not as hot as we say it is. And we've talked about this last week, but I don't think that matters in the big scheme of what's coming, which is the Fed mandate is shifting. But I'll let Quinn hit me with his unemployment takes. Give me some charts, Quinn.
Yeah, Felix. My big takeaway too is how much the Overton window has shifted. If we're talking about like panic Fed cuts when the unemployment rate's at 4.1%, if you just zoom out, whether it's 4.1, 4.2, 4.3, the fact is like these are historically low levels, and the anchoring bias of the markets and the average market participant to the post-COVID levels is just kind of ridiculous when you compare it to historical norms. And I think a big part of that is just how everybody knows how financialized everything is. And so the market carnage that would come with a 5, 6, 7% unemployment rate at these types of levered, levels, kind of gets to Tyler's point of how everyone just has to control the volatility. But a couple slides, I actually talked about this in a talk I gave Felix at the conference we were at, but I updated these numbers since then for today's print. And this is what we've been talking about for a long time, is there's about 4 times as many native-born workers than foreign-born in the U.S. On the left side, you can see that. The blue is native-born, total employed. Gray is foreign. But what you see in 23 and 24, the biggest disinflationary years in the U.S., there is actually over 2x the new jobs for foreign-born than native, which basically just shows how ridiculously high immigration was to have that happen, where they're doubling the new jobs of native despite 1/5 the size of the workforce. And then you can see the huge mean reversion year to date in June, where the blue line native born new jobs compared to the foreign born new jobs in the gray. And so this is, the next slide shows this as well, a table version, but it just shows the magnitude of this sea change that is a direct result of immigration. So over 2 million native born jobs and only 500 foreign born new jobs this year, which goes against the trend. And really, this was a huge cause of the disinflationary effects from 2022 on. Basically, when Biden opened up the borders, it was for one sole reason, and that was to quell inflation. And you can see that in the border statistics. You can see that in wage growth. Bachelor's, the next slide shows bachelor's and higher, less high school and lower wage growth. That bottomed, meaning bachelor's and higher wages started growing much faster when they opened the border in 2022, because all the immigration competed for the lower income jobs. And then on the last one, I just put in the transcript from the last FOMC press conference, where a reporter did ask what they expect what Powell expects these workplace raids and immigration reduction to do. And he basically just pointed at the unemployment rate and just noting how solid it is. And he commented that both demand and supply are moving down at the same rate, and that's keeping unemployment, rate percentage steady. And that's what we're seeing. And so it's an interesting argument, because the doves, or people that want the liquidity, will say, well, the economy's slowing because we're creating less new jobs because there's less people coming in. But on the hawkish side, you could say, well, per capita outcomes, aka like the unemployment rate percentage of the total labor force, is actually good and the same, and the skew is more native. So the economy is actually fine. So it's a really interesting dynamic, one that it's the inverse of 23 and 24 that was very disinflationary. So we're hitting like a economic deceleration here, not a recession, but a slowing from the rate we're at. So you could argue that decline in demand for labor kind of coincides with also the decline in immigration, and the net effects might not be much. So all in all, July odds went down to 5%. So safe to say September's the next one everyone's going to speculate over. and probably panic about, but I wouldn't even say at this
I
rate
think
that's very clear.
I think this chart is really like the money chart. It's so good for just characterizing the play of what's happening with this generation, which is it really comes down to wage growth and this idea of that Tyler was talks about of capital versus labor. And I think when you look at this, it just you really come to the realization that so much of the success in fighting inflation came from just like opening the floodgates as opposed to rate hikes from the Fed. I think we're just more and more in this world where short rate interest rate changes from the Fed are just they don't have the oomph that they used to, especially in just like a highly indebted world that we're in now. But with this was the driver, and I think it's really important to emphasize that we're seeing the opposite now, and you can see that in how Trump and his policymakers are trying to weave this fine line between. When you hear them talk about it's Main Street's turn, to me that means wage growth, real wage growth. So they want to get that, but then they also don't want to let a wage price spiral start to occur because then you get inflation. Then their situation's a nightmare. And this is like what's so difficult right now. Is this like who do you want to let win? Who do you want to let lose?
I think that's the exact point, Felix. And frankly, I don't recall a political pivot the size that we've seen this year because the messaging coming in was balancing the budget, Main Street's turn, and getting the cost of capital down, and fixing the borders. And now we're basically it quickly flipped post Liberation Day to Trump tweeting, "We need to spend to grow," and that everything Bessent was talking about from the Biden and Yellen admin on the manipulation of debt, he's basically advocating for the same thing. So it on one hand, it shows you how, kind of messed up the system is if no one can even pursue those policies that are more fiscally healthy long-term. But at the same time, it's like, man, everybody's just a politician and we're just back because it's probably doesn't bode well long-term because the policies of Yellen and Biden just juicing the market, pumping liquidity and manipulating Treasury issuance is prolonging this two-speed economy where the large caps and the wealthy asset prices do well. And, the lower and middle income are really left behind. Wage growth suffers. And so it'll be interesting to see how all that balances out in the coming years.
You want to know what the irony of this is to me is, so to control inflation, Biden let in, millions of people to basically kill wages. It was like, I think back in the day, it was like Henry Ford used to say, what's good for, the average Ford employee is good for America. Like wages going up is like a good thing. And it was on the left, you basically wanted to squash wage growth to basically make people more subservient to the state and grow, the larger government, et cetera. And, I'm trying to say this objectively. This is not, political by any means, but you can see that's essentially what they were trying to do in hindsight. And now, Trump, is actually maybe even more pro-labor. You're seeing wages are going up and they're taking care of, the native-born Americans. But now the problem is, and I think this is where the real policy shift is really shifting, is now that you have the wage growth, yields should rise. However, they need to finance the government balance sheet. So it's becoming a political thing. They need to stifle. This is the hidden yield curve control where Bessent is not going to issue long issued treasuries to keep the longer rates down so that the housing market can kind of like delever itself. And there's the difference between buyers and sellers will stifle. But you're going to have negative real rates. And that's what I think crypto is kind of sniffing out here, and Bitcoin potentially tapping on all-time highs. And not only that, but like a lot of the frontier markets that I've been talking about is like this policy is completely shifting. And I'd love to read this. This is from Pippa Malmgren from her latest, which I thought was like such a great piece that synopsizes everything since the financial crisis. But she says, here's what's underway. It's nothing short of a controlled demolition warning. This is a cleanup operation of the mess left over from the GFC. The Federal Reserve Bank and interest rate policy are no longer able to address the core problem. The losses from that time are still festering and slowing down the pace of growth in the US. For Trump investment, now is the time to reverse the windfall gains that the bankers and asset holders made during the crisis at the expense of the little guy. The pension funds, the insurers, the corporations that have been paying themselves all too well as a result of the GFC windfall. In addition, any companies that served as fronts for revenue generating sources for the deep state or opposition will no longer have the privilege of state sponsorship, protection, and plausible deniability. They're likely to go bust. Imagine if the US aid problem is deeply embedded in publicly listed firms. These firms might even start declaring bankruptcy now in anticipation of events that I'm describing. Markets are extremely vulnerable to this course correction, this rewriting of the social contract, because they are not comprehending the magnitude of the grain strategy. I've called this process the digital redenomination of your entire life. We must get ready for it. And what she's really hinting at, I mean, it's just like so good. But, I mean, this is without saying it, that I think they're going to a negative real yield policy. They are going to delever the economy by having nominal yields lower than inflation and growth rates higher than that. And
yeah, they're gonna delever by running it hot. Like this is, you know, it's pretty clear that originally, if you just think about it through like a debt to GDP scenario, they're originally talking about lowering the debt. Now we're talking about just running hot the GDP. And this, it feels like it's all coming to a friend now. We're recording this, I think just an hour ago, the House passed the big, beautiful bill. So, you know, that's what's next. And that's what's coming here. And like, just check out this chart of where we're headed on deficits as a GDP. Like 2026, this is CBO scoring, which we'll get into some of the, I'll give some valid criticisms to this in a second, but let's just take this at face value for a minute. Going from a 5.5% deficit as a percentage of GDP in 2026 to 7%. And that is going to stay flat there and accelerate. And just a few different other ways to look at this is that, you know, if we just take the big, beautiful bill that the Senate proposed, you know, in some versions of, depending on how you format the CBO scoring, you get as high as potentially 8%, which is just absolutely bananas. So you have this situation. Now, I will say a few valid criticisms around this in terms of just like, you know, this is what you hear Scott Bessent talking about. He was on like friggin' 3 interviews today, I think. And there's a couple valid criticisms I'll throw into this, which is that one, the assumption that the CBO takes into their growth projections. I don't have the specific numbers off of me, but generally speaking, they have growth lower than what the first term was for President Trump. So their assumption from internally the Trump admin is that we'll see higher growth, which is why you're hearing them talking about, we just want to run the economy hot and outpace the debt. And that's how we're going to see that deleverage. The second thing too, is that this CBO scoring does not take into consideration any tariff income into it, which is interesting because, you know, you can have your criticisms on how durable these tariffs are going to be, but the fact is that they are a thing that exists right now. So I'll just bring up a couple of these charts. You can see if you annualize the tariffs that are currently being collected right now, it's just a bit above $300 billion. And overall, this was a great chart that Bob Elliott posted today that just shows the policy level announced from the tariffs versus what's actually being collected. And you can see, you know, intuitively, it takes a bit of time to really just get the logistics going to actually collect these tariffs at the effective tariff rate that they're proposed. So we still haven't ramped up to the full level yet. And obviously some of this can revert. We're going to see that, you know, July 9th. So it's interesting because the way I understand it is that the CBO doesn't incorporate anything that isn't like fully implemented into law. And that's why they don't include the tariff revenue. So on the surface, it's clear that we're going to like a higher deficit as percentage of GDP. But there is also a couple valid criticisms in there that I think, you know, I understand this, you know, hard line stance they take to not include anything that isn't passed through law. But to me, it does feel a little bit disingenuous to not include any tariff revenue at all when it seems like at the very least, we'll have a 10% effective tariff rate and maybe higher. So overall, you know, I think it's clear. And the other thing on the other side of the criticisms towards the Trump administration is that a lot of the savings, quote unquote, that'll come, you know, basically they front loaded a lot of the cuts up front. And then the idea is that they'll see savings later on. Multitasking here. So you can see in this chart, you can see how the assumption is that a lot of it will be made up in like 2030, 2031. So, you know, when the Trump administration is hypothetically not even going to be there anymore, you know, we could see a Democrat president and that sort of thing. And, you know, just generally speaking, a lot of these times it's those back end savings, quote unquote, never actually resolve them. They never actually happen. So it's like, you know, yeah.
we did see the economy delever a little bit during that, negative real rate. I think we went to 130% deficit GDP, debt to GDP, to like 110 from 115 for a brief period of time before it kind of reversed. But so you can delever the economy with growth. It's just, is he going to create a massive boom like this? This could be the massive wealth transfer ahead of us, right? And what I think what Pip was saying is, and this is what I've been talking about for years, but if you are long short volatility proxies, meaning like banks or anybody who's benefited from interest rates going down for years and years and years, and you own all the paper that's been issued at really low rates, you're probably going to get crushed here. And that money is going to be going into the frontiers, because the short vol trade is done. That's what this is the Maginot Line that Bessent and they tried not to cross it. They try to cut expenses, and now they're fully going full stupid. And it's just a matter of time until people catch on. This is what the new regime is. And if you're at some giant oligarch company, bureaucratic, sclerotic, I know everyone loves when I say sclerotic, but like that's the majority of companies that have benefited from this last generation. And that's unwinding here. And it's going to be so awesome to watch. So
it's not, I agree, but it's not unwinding yet. Like the way this unwinds is not people getting richer. It's from asset values decreasing. And then Felix, the next slide shows, and I'm going to take jabs at both political parties here.
Let's talk about BTC-Fi and why Echo Protocol is critical to it. Echo is the second largest protocol by TVL on Aptos. It secures nearly half of the bridged Bitcoin on the network, with $200 million plus in ABTC already minted. So what does Echo do? It lets users restake Bitcoin, earn yield, and participate in BTC-Fi apps on Aptos, all without giving up control of their core Bitcoin exposure. With just a few clicks, you can mint ABTC and start earning yield, backed by the most dominant Bitcoin layer in the Aptos ecosystem. If you're looking to put your Bitcoin to work in a secure, high-growth environment, Echo Protocol is where BTC-Fi begins. Learn more and start earning at echoprotocol.xyz. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
So this slide shows the average annual change in household resources as a percentage of current law income after transfers and taxes. And it shows that this bill resoundingly benefits the upper class and it does not help the lower class at all. And on a relative basis, that means they're worse off. The next chart shows Broadway attendance on a weekly basis. And we're at record levels. And this is where this is where the Trump administration is really messing up, in my opinion, is Bessent went on was it the Tucker or the All In podcast citing how, we're at the record levels of American vacations into Europe and record levels of food bank utilization. And this is the same thing, record weekly Broadway attendance and record number of Americans who can't afford a $2,000 emergency, over 50%. And so what the Biden and Yellen admin did very creatively was they opened the borders, crushed low and middle income wages, and with it inflation. And that brought inflation down, allowed more easing, allowed asset prices to stay elevated, and completely killed the lower and middle income class. They kept rates high at the front end and yield curve control the back end. So everybody, low income and small businesses who borrow on the front end, screwed, back end, large corporates, rich, benefit. And they prolonged that. And they got the public and the whole left to think that this was all because they're so kind and loving, and immigration, open borders is what you do for the right, good of the people. And meanwhile, so like anytime I would point these statistics out, which is now becoming clear in the labor data, I would be labeled like a racist and all these things, which I'm for immigration, but the data is resoundingly bad.
You're racist.
Yeah. The data is resoundingly bad for the lower income. These are the jobs that people are coming in. And then you had the Trump administration coming in earlier this year saying all the things that people wanted to hear were going to help Main Street. And then here they come with this insane bill that is extremely unequal and not helping Main Street. And on top of that, Yellenomics controlling the long end of the curve and not letting it release. And then also, like, this is the exact problem, pumping asset prices at to dampen vol and everything else. Like, and Jem Carson talks about this a lot, where behind the scenes, no one really understands this, but the ramifications exacerbate wealth inequality and is not going to end well for their administration.
Yeah.
And
look at this tweet. It just spells it out. For all cost-cutting Republicans, of which I am one, remember, you still have to get reelected. Don't go too crazy. We will make it all up times 10 with growth more than ever before. Like, this is literally the plan. Like,
it's a complete sham.
Yeah.
It's complete. It's honestly, like, I'm going to be so shocked if I doubt they're not going to get reelected. There's no way. I mean, the impacts of this bill and Yellenomics that Bessent is continuing to deploy, it just insanely exacerbate the wealth inequality and problem that they were elected to fix. And that's what it's going to boil down to in a few years.
Yeah. I mean, it's going to be Yellenomics on steroids. Like, I'll just quickly say this, and I'll pass it to you. But so when you're talking about it, this is what's going to happen. Look, it says Treasury Secretary Scott Bass indicated it wouldn't make sense for the government to ramp up sales of longer-term securities given where yields are today. Bessent last year repeatedly criticized then Treasury Secretary Janet Yellen for relying more on short-term treasuries in issuance. And as always, Shrub, who quick alpha for the chat, we're actually going to have Shrub join us next week. Going to be a ton of fun. But he always has great memes you can see on the right here where, Yellen walks so that Bessent and Trump could run. And that's really the situation at hand. All right, go, Tyler.
Yeah, I guess. So I agree with that conclusion. What I think they're trying to do is have a wealth generative effect demographically, where if millennials and Gen Zers own crypto, they're going to create a massive boom in crypto to make up the gap in demand. And I think they think, if you think about this logically, if Bitcoin goes to 200K and you make $50,000 in a year on your crypto or whatever, if you're lower income, middle income, just theoretically, that actually should theoretically raise you. If you're making that much money as your salary, whatever it is, your wages should be rising commensurately, because the cost of labor should be rising if it's that easy to attain wealth.
It doesn't work. The 80-20 rule, the top 5 or 10% of wallets own 90% of Bitcoin.
I guess that's the argument but I guess what I'm trying to say is, in these manufactured booms, they need to manufacture a boom, because the wealth inequality is so bad, so that you either do one of two things, you cut expenses and everything deflates, or you kind of try to manufacture a boom and control the inflationary impacts. I think that was the deal that Trump cut with Saudi Arabia and Russia, is hey, look at the oil price. The oil price hasn't even budged. That's what's crazy to me. It's down $67. It's, it's up to 75, not 67. With all this, it's down 0.5% today. And so they got some backroom dealings going on to try to control the inflationary impulses. And they're probably so what if asset prices go up? If we can control the commodity and food inflation and, have wages go up and asset prices go up, that's how you delever the economy with real growth. I think that's what they're trying to thread. And that's why you have to watch credit spreads in oil super tight. And here, I wanted to show these couple charts. This is what's wild to me. So if you go to slide 50, this is the triple C options adjusted spread over Treasury. So this is showing you, when this line spikes, this is the spread on bonds, really crappy bonds. And if it spikes up, that's generally recession guaranteed. It spiked up on the Trump tariffs and when Trump got elected. And now it's coming back down, showing like the demand for super high yield risky debt is still massively in demand. And then if you go to the next one, this is even crazier. This isn't triple C. Triple C is like the bottom of the barrel companies. This is just the option adjusted spread on high yield in general. Look at that come in. It's crazy. I mean, this is what's funny to me is like you're talking about watching the market slowly go out on the risk spectrum here. And then, if you go to the next one, this is your average corporate bond, right? I just wanted to do, this is macro, 101, but like, okay, so your average corporate bond yields 6.15%, right? Your average, 10-year treasury is at, let's see, 4.35. And guess what you can get in DeFi right now, in a US, DeFi yield in just a stable coin. You can get about 7.5%, maybe 8%. You probably get higher than that. There's better experts. But like for having no credit risk backed by $1 in this new world, you can get a better yield than buying a shitty high yield bond.
But there's a protocol risk probably there. That's probably the only. That's probably the only.
Balance. Yeah, you have to balance that. But like to a certain extent, my point is more. That's why this phenomenon of keeping credit spreads low and manipulating the yield curve and not issuing long-term debt, and as debt investors, they keep hoovering because boomers are getting older and older. It makes zero sense to own a bond under this new regime. Like, I'm surprised it doesn't blow up. It won't, because there's like mandated reasons to own yield. But what happens is you keep, as these yields go down, it's like a self-reflexive cycle. As growth goes up, it keeps getting put back into these products. But what's going to happen is you're asymmetrically going to get wealthier if you're out on the frontiers. And that's where like my head goes back to. Until you see oil spike, credit spreads widen, you're going to get stuff like this. And I talked about this weeks ago, but go to slide 54. The ARKK, which is like my RIP Pro Frontier risk proxy. This is
a nice way of saying shitco.
Yeah, 3-year shitco. 3-year cup and handle. But you know what? Look, this is what's fascinating is like, Coinbase is in there. I think, Circle might be in there. There's Tesla's in there. But look, 3-year cup and handle, and now it's breaking out to the upside. And like all the prices are telling you, get out on the risk spectrum, but everyone's hating. They're hating so much. And generally it's probably because, you have these head fakes of the tariffs, and you've had the head fakes of geopolitics of Iran, Israel, but it's getting shrugged off so much. The fixed income market is, at least on corporate bonds, is on fire. And what do you do as a corporation if your cost of capital drops? You're going to probably, hire, issue some more bonds. You're going to buy back stock. Like, that's why the stupid mechanism of like issuing debt to buy back equity, it's just not ending. And more and more people are figuring that out, and money just keeps seeping out into the frontier. So that's my 2 cents for all this thing. And I'm just shocked that, every sniff of geopolitics or headline of fear causes like, recession talk, yet prices are breaking out here.
Yeah. You know what it is too, I think people are mad about it because they have a fundamental misunderstanding of how loose financial conditions are, because they're caught up on a world where high Fed funds rate means the economy is restrictive. So in their mind, they're like, these shitcos, or whatever you want to call them, shouldn't be surging right now. But in reality, we're in a very different world where the financial conditions loosening is coming from the fiscal side of things. The monetary side is completely almost inept in this situation. So you have the situation where things are surging. Yeah.
It's coming from the monetary side too. If you look out in the future, like you can show that Goldman Sachs chart of potential Fed easing, like they're now, you price in what the Fed's going to do in the future. And what's happening is Trump's really strong armed Fed policy to the point where the market is now anticipating the Fed easing. Like in September, we're going to get an ease. Like,
and I think Quinn, I just saw you threw this chart in here, but this is like so powerful to me, because just showing how inflation rises when we tilt towards bills, because this is what I'm getting at that people don't understand, is that this is more powerful than QE. You need to get this into your head. Like, issuing a shit ton of bills is zero duration money printing, basically. When you're running such a, go ahead.
You're 100% right. It's powerful. And I think, Tyler, you're right too, but it's not without a cost. And we're just kicking the can, but it's inflationary. And Tyler, what I agree completely with your synopsis of the markets right now, which is actually what haven't heard anyone talk.
It's a Ponzi scheme.
I haven't heard anyone say this, but it's how I view it is the Fed should not be talking about cutting at all. They should actually, in the next few months, when inflation starts ticking back up, in a normal course operation, they would be talking about hiking. Like, inflation will be ticking up. Everybody knows it. Everybody knows it. All the economists have their projection. Like, it's coming back. And in that case, the Fed should talk about hikes.
How often are economists right, though?
No.
Like,
it's going to happen.
It's the most bogus profession ever.
But there's base effects. I'm saying like the Fed measures but the thing is by Trump blasting Powell, even if he gets no cuts, what he did is he snipped the right tail of hikes off the probability distribution. And that in itself is dovish enough for the markets to say, okay, well, even if inflation rises 0.3 or 0.4, and in a normal case, a hike would come on the table, he's taken that off, and that's dovish. And that's actually in a way how he's won. But the problem, Tyler, is I agree that, okay, the capital, we're too loose, or the system's loose. They want it loose. Their capital's flowing to the frontiers. But the reason Trump got elected, so I agree with that in the short term. I'm just saying the long-term ramifications come with a cost, because that is making the technocrats and the all these people wealthy who are not the ones who ultimately are the populist base, is why he's got elected. And that chart,
the cost is inflation and wealth inequality. Like, that's where we're at.
Yeah. So my point is, I totally agree. And you have to play the game in front of you, not the game you want. But I think that unease and frustration across the market and like populists, like it's still very high, not just markets, is because this wealth inequality problem is getting exacerbated blatantly in your face via all these levers. And it's not like, so people are pissed because it's not actually fixing any of this stuff. Like, look at the Dallas Fed survey of the predominantly oil and gas energy, industry in Texas, like Trump's base who voted him in, another huge drop in rig count, domestic oil producers decimated. Like, this is all great for markets. Trump returned to Trump 1.0, pumped the markets, but it's going to have ramifications, is my point. Like, I'm not sitting here saying like, like all this stuff is ripping and there's a reason. They're too loose. And so like, if nothing's going to change, you have to play that. But I just don't think over the next 4 years of their term, it's going to end well for them, because they're making things way worse.
What if you manufacture lower rates and you're doing like hidden QE against, and I'm talking low rates across the curve, low rates on the front end, lower rates on the back end.
Inflation,
and
the currency goes.
Yeah, the US dollar goes down to 15%.
That's why inflation is going to rise this year, Tyler.
Or do home builders, borrow ungodly amounts of money and create massive home supply, and then oil and gas producers buy massive amounts of money, drill more rigs? Maybe that, there's a surplus if it's a negative real rate environment. Like, that's kind of what happened,
But you're right, and that's what they need to do. But that is inflation. Like, they do need they at the end of the day, they need 3, 4, 5% inflation to that's how you quote unquote grow our way out.
And the currency is the exhaust valve. This is like where I'm at right now is all these roads we're talking about are heading towards Dixie down 15% over the next 5 years.
I got a good chart on that.
Debasement hedges. Yeah, what do you got?
That's the funny thing though, too, Felix, is because the game is international. Like Europe,
they're all fucking doing this.
Europe, Lagarde, she's saying the latest out of the ECB is they're worried that the euro strength is going to cause them to undershoot the target now of inflation. And so they actually need to be more dovish, even though they're at basically 0% real. It's like, and then you have Japan for the last 2 years saying, nah, we're not going to hike this one. We're going to hike at the next meeting for 4 years and never hike. Like, it's just, as Tyler says, the biggest Ponzi ever.
It's a global Ponzi on fiat currencies, because what you're really doing is like you're relatively weighing them against each other, and then labor gets absolutely annihilated, which is kind of what you're saying. But I think what I'm trying to say is labor is figuring out that like you just own Bitcoin. If you just own Bitcoin, you can stay ahead of this. And if you own MicroStrategy, and like that's why Robinhood is actually like rocking here, because like retail is slowly figuring out the game. It took them 15 years, but I'm hoping more people watch Forward Guidance to understand like that's how you hedge yourself in these regimes. Is you have to stay ahead. What's going to be tricky for me in this next 5 years is what the hell happens to all the leverage and the banks, and like if you can finance yourself better in the crypto ecosystem and versus like this legacy thing where you're sitting on commercial real estate, like who's going to want to buy an office building? If it's not New York or, you know, some really highly populated place, like that was a generation of people. If you watch these stupid Instagram things where it's like, how'd you make your money? And they go up to some gaudy loser with like a big Rolex and like a Lamborghini, and 9 out of 10 of them go, oh, I made my money in real estate. I was like, oh, you just levered the tits and you got bailed out by the government every step of the way. And like, that's unwinding. Those people are not going to exist in 10 years, and it's going to be epic.
How about this? One of my favorite articles I've read of the week, just for how mind-boggling these statistics are. From Reuters, how China's new auto giants left GM, VW, Tesla in the dust. BYD makes Louis Vincent Gave is like the China go-to expert for everybody in macro, and he's been talking about this for a long time. How BYD makes 7 to 10K, you know, not quite Teslas. They don't have the full self-drive, all this stuff, but like basically Tesla is at a fifth of the cost or whatever. The article states BYD has 900,000 employees working 12-hour days per week, selling cars for $7,000 to $10,000. That is like, you can't even comprehend. Like, and so you're also seeing this stuff out of China, how like she is trying to steer industry away from super low cost, you know, into higher costs, and like getting rid of just the pure export driven economy. And again, another inflationary thing, the tariffs are, you know, putting a blocker on the disinflation that China was sending into the US at the expense of our lower class. But that just gives you an insane magnitude of how much labor has gotten so crushed globally, when you can outsource to China, where they'll employ 900,000 people working 12 hours, 12-hour days for like 5 cents an hour.
It's wild.
And that's going to reverse. Like it's going to take a long time. This is like a 10, 15 year thing, but you know, you can't taco indefinitely. And that when it comes at the direct expense of the people who got you in is basically my point.
Tyler, I want to bring back up your Dixie chart and circle back on there, because I think this is still like the big theme. I just pulled it up because to me right now, the only thing holding up the dollar from really falling out here is just the Fed being sitting on their hands basically and not cutting it. But we know that this is coming, and it just feels like the last shoe to drop. But yeah, what's your read on this?
Well, this is from 13D Research. Kirill Sokolov's. It's awesome view of pretty much everything. We're at extremes, and I think you know, I've said this, but in the short term, people are overly positioned short the dollar, and you could have a rally. I think the dollar rallied actually today quite a bit, but longer term, if it does keep breaking down, like that could light a spark. And if this is really the policy change that Bessent and Trump kind of nudging through, and people start figuring it out, you know, this is Weimar Weimar U.S. territory, where if that dollar breaks down, you're basically scrambling for how to protect yourself, in the future. So it's something to really watch here on the monthly chart, but it still takes a while to play out, obviously.
Yeah, I think that like the idea of going to outright just like almost only bill issuance and letting the dollar fall, like that's a lot more Weimar-y than QE infinity. I think people got too caught up on the whole QE thing and just because of recency bias, but I feel like the game we're playing now is a lot more dangerous, honestly.
Doesn't it feel like we're really at the end of this central banking thing? And the irony of the whole thing, the whole system is set up to buy paper. It's to buy this short volatility, Warren Buffett, risk adjusted returns, type of mentality of, I can buy a bond and hold it and save it and expect that the government's going to do the right thing. That mentality is just, it's, I think we're at this moment where people are realizing, holy shit, there's a socialist in New York City that's going to just,
yeah.
Dude, the politics
being in New York when that election happened was just crazy.
Yeah. And but you know what? I understand why, I'm not,
nobody should be surprised about it.
No, it doesn't. It makes a lot of sense because you spent 15 years, handing money hand over fist to an oligarch elite class of people that forgot about American middle class. It's
here's another point, Tyler, that while I agree with your premise that while the sugar hit and, the Fent hits for Felix in Felix's term, he feel good. You go into the frontiers and you go into this stuff where the capital's flowing out the risk curve. But shout out to Paulo Macro, who points this out. He's, has a lot of experience in Latin America and always talks about how the US, the EM-ification and DMs becoming EMs. And in the 1980s in Brazil, this is the blueprint. So I totally agree. It's like, wow, we've been talking about these things coming together and it's feeling like we're getting just ever and ever closer. In the 1980s, Brazil had almost 100% of the federal debt being rolled every day in zero duration bonds. So if you want a blueprint for where this game ends, look no further. And it's not pretty for your frontiers and your entrepreneurs because the inflation situation gets so bad.
Wait, it might be in the beginning. I think that's what I'm seeing. The prices are telling you, like, people are starting to figure out I'm cooking in bonds. Like the inflation's higher than where bond yields are, right? So you got to move. You keep moving out your risk spectrum, and then you get the credit event that's like, oh shit, there's the haves and have-nots.
Well, nominally too. Nominally, everything, all the shit's gonna go up nominally, but it's on a real basis what's gonna perform. And I mean, it's a long trend.
The trippy part right now is that all of this it's all a currency game. Like we're at this stage of it now, and so the issue is that you have, for foreign investors, in Europe. Like I was reading an article from Schwab today where he was mentioning about how NASDAQ in euro terms, when you look at what's happened there, they're still down about, I think, 9% year to date, whereas the NASDAQ just hit an all-time high. So, those allocators are getting smoked because they're not hedged on FX terms. And I think that's sort of the main risk, is that when you get into this EM-ification of the US, is it starts to become a currency game. And then that, there's a lot of different moving parts of that. And I feel like that's where you sort of go in different directions of, I think in the beginning, yeah, for sure. And especially nominally, it's super bullish. But if you start to get the capital flight situation, that's where, it can be a bit more hairy. That's why, like, to me, gold and Bitcoin is just like a much cleaner trade, I think.
Tyler, what do you make of Felix? Go to those volatility slides I put in, because I wanted to touch on. We can't go a show without talking about Tyler's favorite asset, MicroStrategy.
Oh, dude, I love this. Let's go.
I want to get your thoughts on this because MicroStrategy volatility is at like, I think that's 2023 lows, pre, a lot of this run up. IBIT IBIT's Bitcoin, same thing, is at extreme lows as well. So just curious your thoughts on this, because to me, To me, low volatility for MicroStrategy means less ability for them to issue all these exotic securities that require that where they monetize the vol. And I believe the reason MSTR's volatility is so low is because they've harvested and they've monetized all this volatility. They're selling basically upside on the stock. Less and less people want to gamble and speculate on the upside, and you're seeing people go to other things. And so then the stock like doesn't move anymore. It's like it just like kind of like sits in a straight line versus Bitcoin.
Oh, I disagree. I think it's about to break out.
Yeah, I'm curious to like hear your why and like about this vol or like okay. So why is the volatility where it's at? If you or maybe you agree with me, and then if like your case for it breaking out. I don't have a
view. Well, I mean I think it was it had that giant rip, and then you had a consolidation. It's basically making a cup and handle, and IBIT's doing the same thing. And I think the fact that vol is low here, meaning like you actually get paid to buy upside now, relatively, and I think you're going to get into the self-reflexive gamma squeeze type vol, and if there's no geopolitical event this time, I think we're going to do this crazy vol squeeze again in Bitcoin and in MicroStrategy here. And I'll probably go on record and be wrong on this, but I bought some upside MSTU call.
Wait, is that the 2x?
Double lever MicroStrategy call. Just as a flyer. Because I mean, like, I think Bitcoin's going to break out here, and I think strategy is going to absolutely just...
What's the liquidity on those? You could put like $4 into them or what?
No, it's actually it's very liquid. But, I went out a couple months. So I have some theta there, some time value. But if it happens and you get this, I mean, like Bitcoin's tapping on the door of 110 right now. And God, I mean, all the macro is telling me credit spreads that ARKK, like you're seeing the charts. Like if you see what happens to Bitcoin miners, first of all, those usually move first, but there's a whole nother thesis going on there with AI infrastructure. But everything is setting up for what normally would be a cup and handle breakout. And I think the fact that Mr. Vol is this low gives you a great risk reward to buy upside here.
That's what I was thinking. Even just like you buy a put, buy a call, same like.
Yeah,
I mean, vol is in a historical decline for Bitcoin when you have the asset capitalizing higher. It seems, but some people argue against that. I guess, but the trend is obviously over a long time present down to me. But it does seem that the only thing is like, and like.
Here's the other reason.
Everybody just wants to buy. Like everybody's like wants like it's like everybody's such momentum investors in crypto where it's like this is gonna break out or this is gonna break down, and it's like sometimes it just does nothing for like 3 weeks, or even it just grinds in one direction, and then your vol.
Yeah, but I think to your point about where volatility's at, it feels like a straddle or something's a good play. Vol's gonna go up. Like it's just seasonal too, right? Like we're in early July. And obviously, like every summer, it feels like it's going to be a little bit less volatile. That's probably why you're seeing new lows in it versus last year.
Well, here's the one last thing I'll say on just vol in general. Check this out. Go to slide 58. And this is partly the reason I took a swing here too. But look at July's seasonality. This is, over the past 20 years. July is generally up because what happens, and if you go, here's another way to look at it, is go to slide 59. Look at
I saw this one recently. Yeah.
Monthly returns in July. And this is why the market is just a giant, it's a bell curve. It's a VIX trade. It's just like Jim Carson. And then go to the last one, slide 60. You can see it's a little dated, but essentially, like, look at July. Vol generally seeps lower and lower because everyone's on vacation. So they buy all this protection, then nothing trades. And if you have really low volatility at the index level, stuff kind of like seeps up here a little bit. And I might change my tune, but I don't know. The setup is pretty delicious, and I'm especially because you don't have euphoria as well, or at least I don't think you do. But
yeah, in the sense of like the normal Bitcoin indicators of massive leverage levels and I would agree. I agree. I mean, that's true. Like you're seeing like funding rates at lows. It's a weird market environment, man. Like it's
even
weird...
in TradFi, I think net leverage is still off. Like it hasn't reverted fully yet, even though we're at all-time highs.
Yeah, those charts get thrown around, but those are hard too because like they never run full, and gross actually has continued to go up. So like people never really like degross. Gross is still going up, which at some point probably gets flushed.
There's going to be some momentum unwind, and it'll be some quant thing that like
that kind of happened on Monday a little bit. There was a momentum reversal. Yeah, it was like the biggest momentum reversal since that DeepSeek day. So it feels like that maybe part of that already happened. Like you saw IWM, I think, was up like 1.5% that day, and then Qs were down 1%. And like everybody's short leg is the Russell, so that makes sense.
Yeah, that was a wonky day. You had rates up, but home builders up 4%, which they're normally inverse. You had like it was just some crazy moves. It was interesting to me how people talked about it, but it's just kind of like after is like, oh, don't look over here. Like it was a clear like hedge fund degrossing day where like all the big hedge fund long short pairs just reversed in a massive way. I think everybody was like super scared of this labor print and just hedging or just taking gross down. But maybe it never comes around again, but the even when net came down, gross on all hedge fund exposure just kept ascending vertically. Usually those come, you're picking up pennies in a roller coaster in front of a steamroller, betting against it. But at some point, it will rear its head again. It's just it's impossible to predict when.
That's why I like the quant world. That's just like trading dispersion, and they just all get carried into the same trades and then blow up because they're all in the same pod shops. It's just hilarious to me. Versus like there's some very less stressful trades that you could take in the world.
I think I was listening to someone who was saying how like, and Tyler, you talk about this, like the era of fundamental investing is gone, but the interesting chart that showed percentage of volume traded, like single stocks versus ETFs, and how it's moved to this like thematic analysis world where everyone just like take uranium miners, like no one, 90% of the capital. Yeah. They don't know anything about this.
Investment management has been completely obfuscated by quant shit. That's why it's partly a Ponzi. If you're so centralized that you can do that, like as a platform or whatever, that shouldn't exist. Like you want to buy a stock because the CEO has great ideas and it can innovate and be ahead of the future. And like the whole process of public markets, it's ironic because they're just kind of squeezing the middle class. Like they're not really investing in growth for their children. You're literally moving alpha from one part of the world to the other instead of creating things. We're not creating things. We got a lot smarter, but we didn't invent anything. And that's
all crypto VCs investing in friggin' treasury companies. It's like, Jesus.
Yeah.
That's
what's one of the worst like symptoms of this financial engineering shit that is just, if you look at, we talked about this a couple of weeks ago about Ted Cruz talking about removing interest on reserve balances, and I've been digging into it a little bit more, and it is like pretty insane to me. And the reason I bring this up is because JP Morgan authorized a whole bunch more buybacks, and effectively, like when you look at really what we're doing there is we are subsidizing corporate bank profits and corporate bank buybacks through reserve balances. So the banks get a bunch of reserves, they park them at the Fed, they get 4.5%, and then they take that 4.5% and they buy back their stock. Like, are you kidding me? No wonder we have socialists getting elected in New York when you have that shit happening.
Right? And then Jamie Dimon calls Bitcoin rat poison, and you're like,
and then Jamie Dimon's just like, we're going to go into a recession, and then in the meantime, he's buying back his shares.
And dumping his personal bags into the buybacks. Like,
dude, we should do a 10-minute section of boomer hypocrites and just like they deserve a firm kick in the nuts. And I like Jamie Dimon, but like, just there's no like self-awareness. And please roast me in the comments if I'm, I deserve a good roast for all the shit I've done wrong, and I'll eat it. I'll take it in the face. Like, that's part of being in a locker room. Most of these guys never like got in a fight before. Just like someone needs
this guy's got to play some hockey or something.
Like,
come on.
This is the sign of the times, though. Like, if you take a step back here, and we're three guys in our at home offices talking shop on markets, but years ago Tyler wore a suit going into the office.
I hated myself.
Decades ago for him. But I worked at, we worked in in Wall Street jobs that like are the most capitalist, like free market, often conservative and Republican leaning for their markets views and like deregulatory nature. I am like very free markets person, like all, the opportunity that I feel like I've had in my life, a lot of it is, I've benefited from has been as a result. But so it's just so incredible to me to be finding myself consistently siding with these more populist type movements of like, okay, I worked, like, my job is to make money, and I still am like, man, this is really, and I'm like advocating for against these things that exacerbate the wealth inequality. And it's like, asset managers is a profession that's not going to benefit when these changes ultimately get effectuated, and it's clear they won't do it peacefully. It's going to have to be by force. And like, our careers, generally speaking, are like not benefited by these changes, but like, it's just so messed up. Like, you can't with a straight face advocate for these things. You can't with a straight face side with the guy of the CEO of the largest bank in the US who's selling his personal holdings into the share buyback and like just lying to your face. You can't side with the like rich, like the $900 million wedding and Bezos is having in the Mediterranean. Like, and we're like the most capitalistic free markets people you can pull on.
Yeah.
Like, I can't imagine what my parents or family feels like. Yeah.
I would say that's what pisses me off is everyone's like, you're hating on boomers. I'm not hating on boomers. It's just, I am a free market capitalist, and it's not a free market. Like, and I think that's it, and I can understand when you like, you put in a socialist because you've been screwed, because it's not a free market in a lot of senses.
But the funny thing is, the effects, like, it's almost like, because the free market, like quote unquote free markets people won't actually be free markets and they're actually centralizing, you actually need, like, the burn it down mentality is actually closer to the end goal of getting back to a free market than it is prolonging the BS facade. And that's why it makes sense for people, because they're like, none of these socialists actually pretend, and no one actually thinks they know markets are going to do anything that's healthy for markets. And that's kind of the point, because everyone's like, you guys have perverted the markets so bad, and you're headed in a one-way train into even worse part. And let's just elect someone. I don't care what they do, but the thing's got to be better than what we're dealing with. Like, it's just desperation. Like, it's just so odd to me. And I see it in my friend groups, and it's not even a red versus blue, liberal versus Republican. Like, it's just like it's class. It's common sense. It's like, you can't
but
have.
You know what? This is why they made it a race thing in they made it all these other things, because it really is, at the end of the day, it's a class thing.
Yeah,
and
it's the politicians
starting to realize it's a class thing.
Always.
Anyway.
The more you can keep men versus women fighting, Republicans versus Democrats fighting, blacks versus white fighting, all these things, everyone's focused on each other, and no one's like, wait, who's controlling the puppet strings up there? Oh, wait, they're both Democrats and Republicans. Oh, wait, they're the people we elected. Oh shit. Like,
why am I getting devalued 4.5% so Jamie Dimon can buy back stock? Huh.
Yeah.
Was it Billy Madison where the guy's like, O'Doyle rules? I think like the boomers are like, O'Doyle rules. And then Taylor goes, I got bad feelings. You got something bad coming for you someday. Right now, I got to study.
Tyler, I
That's
want to hear your
That's
take.
what I feel like we are. when O'Doyle goes down, the boomers are like, your system sucks, dude.
I know we're going way over, but this came up in our group chats this week because we have a couple buddies like starting families down here and looking to buy homes. They've been renting and they're like, okay, want to move into a place, and it is over 2x the cost to buy a home than it is to rent in Florida, and that is with a like 25 to 30% down payment, which you have massive opportunity cost of capital on. And so it's like, how does this correct? Well, renting, yeah, it's insane because you're renting the rental price is the cost of this service or good. And to buy that in perpetuity, like the utility of that must offer you extremely high reward and value. But like the debate in the friend group is like, how does this resolve? Like, will home prices ever fall again? Is kind of like what people, and ultimately, like, you just have these 2%, 3% mortgages. No one's moving. Everybody's just renting instead. And it's this insane dynamic again, that just screws all the like lower income people. Like, and I'm lucky. I'm like, fine. Like, I can't imagine if you're not, as well off as some people.
Wait till you guys have kids.
It's crazy, man.
They're expensive as hell.
Dude, daycare? Oh my God. Yeah.
So,
all right, guys.
There's only one way.
Yeah, there's only one way. We'll leave it there. That was fucking awesome.
Sorry,
I hope everybody has a great.
Got people riled up before they're supposed to be celebrating their pride in this country, and we're just shitting on it.
Yeah. Let's leave it on a happy note, which is that I like the fourth turning framework. I know people call it doom porn or whatever, but to me, it gives me some optimism to know that things will get better. We will recreate these institutions. Yes, it might get a little bit better, a little bit worse in the interim, but don't short human innovation. I think it will get better. So celebrate that part of society, human innovation. There you go.
From your favorite Canadian.
Well, I think it is a long-term positive because the 4th of July is celebrating the people and everybody around you. And it doesn't matter where they're from or where they're born or what their beliefs are. It's like one another and like, yo, we're here for let's enjoy it. Yeah. And it's like, in a way, it's a time to sort of, 4th of July, what's the U.S. independence built on? Revolt and speaking your mind. And so in a way, this is the best holiday to kind of celebrate this idea.
Yeah. I got to say, man, when we were in DC and like as a Canadian seeing those landmarks and monuments for the first time, I got pretty fired up. I was like, let me just wave a little American flag here for a minute. It was cool. You guys got some cool things going on.
Agreeing with us today. Thomas Jefferson, Abe Lincoln, all these people, they like the founding fathers would despise.
They would be Bitcoiners.
They would be
1,000%. They would be in disgust with the current system.
Yeah. There you go.
So it's a reason to celebrate. Back to the
There you go. All right. Have a good long weekend, guys.